A single announcement by the Reserve Bank of India, whether the repo rate is cut or increased, has the power to move the stock markets, change the value of the rupee, affect your home loan EMI, and even shape the future of the Indian economy. But how does this one decision create such a wide ripple effect? In today's video, we will break down the RBI's repo rate cut and rise and understand their impact on the Indian economy, the securities market, and the rupee's appreciation and depreciation with simple examples and real-world logic. Let's begin. What is the repo rate? Before diving into the impact, let's clarify what the repo rate actually means. The repo rate is the interest rate at which the Reserve Bank of India lends money to commercial banks. If banks need short-term funds, they borrow from the RBI by giving government securities as collateral. So imagine the repo rate as the RBI's master switch for controlling inflation, money supply, borrowing costs, and overall economic activity. Whenever inflation rises or the economy needs correction, the RBI adjusts this switch. This is why the repo rate becomes the most powerful tool in India's monetary policy. Why does RBI change the repo rate? There are two major reasons why RBI changes the repo rate. 1. To control inflation. If inflation is high and people are spending too much, RBI increases the repo rate so borrowing becomes expensive. Money supply reduces, demand cools down, and inflation falls. 2. To boost economic growth. When the economy is slowing, unemployment rises, and industries need support, RBI cuts the repo rate. Loans become cheaper, businesses invest more, and consumption increases. So, repo rate decisions are based on real indicators like inflation, GDP growth, liquidity levels, and global economic conditions. Repo rate cut, effects and impacts. Now let us understand what happens when the RBI cuts the repo rate. A impact on the Indian economy. When RBI cuts the repo rate, borrowing costs drop. This triggers several changes. 1. Loans become cheaper. Home loans, car loans, education loans all become more affordable. This increases demand in sectors like real estate, automobiles, consumer durables, etc. 2. Businesses expand. Lower borrowing costs mean companies can take loans at cheaper rates. This helps in setting up new factories, hiring more workers, increasing production. This boosts economic growth. 3. Increase in consumption and demand. Lower EMIs leave more disposable income with people. When people spend more, businesses earn more, and GDP rises. 4. Short-term risk of inflation. When too much money enters the economy, prices can start rising. This is why RBI cuts the rate only when inflation is under control. So, a repo rate cut boosts economic growth but carries inflationary risks. B. Impact on securities, your stock market. A repo rate cut generally leads to a positive reaction in the stock market. Why? Lower interest rates mean companies pay less on loans, higher profits. Consumers spend more, boosts corporate revenues. Investors shift from low-return instruments, FDs, bonds, to equity markets. Sectors that benefit most: banking and NBFCs, real estate, automobiles, consumer goods, infrastructure. Overall, a rate cut acts as a stimulus to financial markets. See impact on rupee value. A repo rate cut usually puts downward pressure on the rupee. Why does the rupee weaken? Because foreign investors earn lower returns on Indian bonds and fixed income products. This may cause them to withdraw money from India. When foreign investors take money back to their home countries, the demand for the rupee falls, leading to rupee depreciation. Effect of rupee depreciation. Imports become expensive, fuel, electronics, machinery. Exports become more competitive abroad. Inflation may rise due to costlier imports, so a repo rate cut may boost growth but can weaken the rupee. Repo rate hike. Effects and impacts. Now let's look at the opposite situation when RBI increases the repo rate. An impact on the Indian economy. When RBI increases the repo rate, borrowing becomes expensive. 1. Loans become costly. Higher EMIs discourage people from taking loans. Demand for homes, cars, and appliances slows down. 2. Businesses reduce spending. Companies delay expansion plans because financing becomes costly. Production slows, hiring reduces, and GDP growth can decelerate. 3. Inflation comes down. Higher interest rates reduce excess money in the system. People spend less, so prices of goods and services stabilize. 4. Slowdown in multiple sectors. Real estate, auto, construction, and retail feel the pressure. So a repo rate hike cools inflation but slows economic growth. B. Impact on securities, stock market. Stock markets usually react negatively to a repo rate hike. Why? Costly loans reduce corporate profits. Consumers cut spending, lower revenues. Investors shift from equities to safer fixed income instruments. Sectors that get impacted: banks, autos, realty, infrastructure, metals, and capital-intensive industries. Markets often fall or become volatile after a rate hike. C. Impact on rupee value. A repo rate hike generally leads to rupee appreciation. Why does the rupee strengthen? Because higher interest rates attract more foreign investors. They invest in Indian bonds and securities to earn higher returns. This increases the demand for the rupee, which strengthens its value. Effects of a stronger rupee: imports become cheaper, good for oil, electronics, machinery. Inflation reduces due to cheaper imports. Exporters may feel pressure because Indian goods become costlier abroad. So a rate hike strengthens the rupee but may hurt export-oriented sectors. Let's summarize the entire discussion in a simple way. When RBI cuts the repo rate, borrowing becomes cheaper and the economy grows speeds up. Stock market rises. Rupee tends to weaken. Risk of inflation increases. When RBI raises the repo rate, borrowing becomes expensive, economy slows down, stock market becomes negative, rupee tends to strengthen, inflation comes under control. In short, RBI uses the repo rate as a balancing tool to support growth on one side and to control inflation on the other. Every rate change reshapes the Indian economy, financial markets, and the value of the rupee.